We are diving into surrender charges and free withdrawal provisions for the national portion of the life insurance exam. It is vital to understand that a surrender charge is essentially a penalty for early withdrawal or cancellation of a cash value policy. These charges are often referred to as back-end loads because they are assessed at the time of surrender rather than when the premium is paid. On the exam, you need to recognize that the primary purpose of these charges is to allow the insurance company to recover its initial acquisition costs. When an agent sells a policy, the company pays out commissions and covers administrative expenses. If a policyholder cancels the policy in the first few years, the company would lose money without these charges. You will typically see a surrender period lasting anywhere from 6 to 10 years. A standard example used on the exam involves a declining percentage. For instance, a policy might start with a 7% surrender charge in the first year, 6% in the second, and so on until it reaches 0 after the 6th or 7th year. This is often called a step-down schedule. One area where the exam likes to trip up students is the free withdrawal provision. Most modern contracts include a feature that allows the policy owner to take out up to 10% of the account value each year without any surrender charge applying. Even if the policy is in its second year and has a high surrender charge, that first 10% is usually off-limits for the penalty. If you encounter a test question asking about a client who withdraws 8% of their cash value to pay for an emergency, the answer will likely be that no surrender charge is assessed because it falls within the free withdrawal limit. It is also important to differentiate between a partial withdrawal and a full surrender. In a full surrender, the entire contract is terminated, and the surrender charge is applied to the entire cash value amount. In a partial withdrawal, the charge only applies to the portion of the withdrawal that exceeds the 10% free limit. Another critical exam point involves waivers of surrender charges. Insurance companies realize that sometimes people need their money due to extreme hardships, so they include specific triggers where the charges are waived entirely. These triggers almost always include the death of the insured, the diagnosis of a terminal illness, or the policy owner being confined to a nursing home or long-term care facility. If a question asks if a beneficiary receives less money because the policy was only in its third year, the answer is a firm no. Surrender charges are never deducted from a death benefit. The death benefit is the face amount minus any outstanding policy loans and interest. But surrender charges are strictly for the living policy owner accessing cash value while the policy is in force. When you are sitting for the exam, watch out for trick wording regarding the calculation of the charge. The charge is calculated based on the amount being withdrawn or the total cash value, not the death benefit amount. If you see a question that mentions a 7% charge on a $100,000 death benefit, that is a red flag designed to lead you to an incorrect answer. To help you remember the standard declining structure of these fees, use the mnemonic, the step-down 7. This reminds you that the charge typically starts around 7% and steps down every year until it hits 0. Always look for the word net when calculating what a client actually receives. The net cash value is the gross cash value minus any surrender charges and outstanding loans. Mastering these distinctions will ensure you do not fall for common traps involving policy liquidity and early access to funds.